we've talked a lot around this table about whether the S&P staying where it is because people still expect the Trump administration to deliver something, or on the contrary, whether there are fundamentals that are really supporting the market almost regardless of the Trump administration. Which is it for you?
I go for the regardless, because I remember the day when we used to say it was terrific when nothing happened in Washington. And now we seem to say that if things don't happen, it's terrible. So, no, markets move up because money is plentiful and cheap, and economies are expanding, and earnings are growing as a result. And, of course, we just had a terrific first quarter earnings season, and the Fed is being really slow in terms of raising rates. So money's loose, all is good, and that doesn't mean we won't get the odd bout of volatility. Of course we will. But generally, I wouldn't be concerned about Trump. I think there's far too much ascribed to his ability to move the market in Q4 and his ability to not move it in Q1, Q2, if you like, of this year.
So, Jason, is it merely a coincidence that, as we just saw, the S&P went up starting with the election? I mean, is it just a coincidence these things would have kicked in anyways?
Well, there's two things. And, you know, if you look at a graph of technicals, so the 120-day moving average for the Dow and the NASDAQ's been a critical technical for the last few years, closed above that level the day before the election, which was a strong buy sign, and eclipsed losses the previous couple weeks. We haven't gone back below it since. But I would disagree with Chris, because I do believe that there is a lot hinging on these tax cuts. Most of my clients are corporate. They expected back in October, 89% of our corporate clients expected a recession by the end of this year. As of a most recent survey at the beginning of April, only 11% expect a recession by the end of this year. And by the way, it's not a reflation trade that I think we're seeing here. I think it's a revaluation trade, because a lower corporate tax rate affects private company valuations in a discounted cash flow model, and this is something that valuators are currently doing. And although we think of public companies as being valued in terms just of market cap, you know, share price times number of shares gets you a number, there are also DCF models that analysts use, and they have to put in lower tax percentages to account for the probability of these tax cuts. And that lower tax rate boosts the value of every company in the entire economy.
Chris Watling?
Well, it's a great point. Of course, lower tax rates help, but there is no correlation between valuation and 12-month returns in the stock market going back over the last 100 years. So to argue that the valuation is the key is just not what's driving markets. It's flows, it's liquidity, and that's really the bottom line. I mean, you could argue the market's expensive today, as you would have argued in 1997, 98, and it would have gone up another 30 or 40%. So yes, of course, tax cuts help, particularly if they're unfunded, but really liquidity is the key, in my opinion.
Jason?
Well, I think the most important equation here isn't whether we're looking at historical valuations or we're looking at PE ratios. I think it's expectations minus reality equals disappointment. And if we don't get the tax cuts, you're going to see sell-off. I really think so.
Chris Watling, should we put that in a textbook, the new equation?
Well, it's a good equation. I like it. It sounds interesting. Well, look, I mean, maybe that's right, but I mean, the S&P is at a record high. So how much disappointment's priced in there? We all know they're struggling with tax cuts and passing policies, so surely we should already be off the highs, and we're not. So I'm not sure that's the right way of thinking about it.